But life during COVID-19 is now the new normal. And there is likely to be another new normal post-COVID-19. We are hearing a lot of phrases like the new norm in the travel industry, the new normal of working from home, perhaps even post-COVID. What about investments? Is there going to be a new normal for investing? We have a series of 5 short presentations today covering this topic. Just to set the scene, our first presenter will be Beryl Bunyasi from Zamara, who will give us an update on the performance of pension schemes up to 31st of March. We will then move on to some outlook discussions on private equity and property. These will be covered by David Owino of Ascent and David Luigi of Gen Africa. Some of us may be looking at investing in these asset classes. Are there some opportunities coming up? Perhaps before COVID, we may have been looking at coming out. Is this still an option for us? We will see what is in store with private equity and property. We will then move on to perhaps what else is out there? What else could we be considering as opportunities? Could Eurobonds be an opportunity for pension schemes? We'll hear from Dan Gathogo of Sanlam on these. Our final speaker will be on derivatives. Derivatives are available in Kenya. Can these help us in managing risk? Peter Anderson of UAP Old Mutual will share more on these. We will then have a Q&A session. Throughout the webinar, you will see a Q&A tab appear on your screen. Please use this to ask questions throughout as and when different speakers are speaking. Please just specify which presenter your question is for. It will make it much easier for them to respond to these questions. Also, throughout the presentation, throughout the webinar, you will see a couple of opinion polls appearing on your screen. So please do respond to these. We'll be sharing all the responses at the end. Now, our first speaker, Beryl Bunyasi, is a key member of the asset consulting team in Zamara. She will be presenting an update on scheme investments. I've asked each of the speakers to share with us some of the positive experiences during this time. Her positive experience has been wearing very comfortable clothing while working from home. So that has been a big positive for Beryl. Beryl, please come on the screen. Please share your screen with your presentation and take over.
Good morning, all. Once again, thank you for joining us today. I hope you can all hear me. I will be taking you through the Zamara Consulting Actuary Scheme Survey for the quarter ending 31st March 2020. A bit of, sorry about that, having a few technical issues. A bit of a background on ZCAS. The purpose of the survey is to analyze the investment returns of Kenya's pensions industry. It has been running since March 2006 and is published quarterly. We received data from 9 fund managers who we are very grateful to for participating in our survey. And as a result of this, we had 415 schemes in the survey who had a total asset value of 852 billion. It's important to note that the Kenyan pension industry has assets of around 1 trillion. This means that our survey covers effectively around 80% of the pension assets in Kenya, so it's an effective benchmark for pension schemes. For effective peer comparison, we do categorize the pension schemes into 3 risk profiles. This is conservative, moderate, and aggressive. This is in accordance to how much you have invested in fixed income, as fixed income is usually categorized as a safer investment in Kenya. So if you have over 80% of your allocation to fixed income, we do categorize you as a conservative investor. And if you have less than 65%, we normally categorize you as an aggressive investor. So just to set a scene for the quarter, we started this decade with a lot of market turbulence, and this was attributed to 3 key factors. The first factor was, and the still prevalent factor, is COVID-19. COVID-19 has seen very many countries going into lockdown. We've seen very many people lose their jobs, and also just a great hit to the global economy. As a result of the lockdowns and all the other factors, investor sentiment has greatly changed. In Kenya and globally, investors are choosing to invest in their home markets and also invest in safer investments. So we've seen a drop in offshore investments, we've seen a drop in equity investments, and this will also translate into your returns as pension schemes. We also had military tensions between the USA and Iran. This led to an upward rally of the price of crude oil. And then later in the quarter, we saw the price was between Russia and Saudi Arabia, led to a decrease in the prices of oil. So as a result of lower valuations of equities, we saw a shift of schemes from aggressive and moderate towards a conservative risk profile. In December, we had 22% of schemes being conservative. Now we have 39.3% of schemes being conservative. The aggressive bar really lowered. We now have 2.4% of pension schemes being considered aggressive investors. Over the quarter, our stronger asset class was fixed income. As you can see, we had a return of around 2.6%. And the benefit for us is most of our assets are actually in fixed income. So despite the low returns in quoted equities and offshore, we were able to somehow salvage our performance. So the 2.6 really helped at least kind of bring you towards a positive return rather than a very negative return if you had around 25% in quoted equities. When we look at a longer term period, we can also see that fixed income has been the stronger performing asset class for Kenya. This is due to very many factors over the last 5 years. We've had the interest rate cap, we've had the Eurobonds that have helped ease lending here in Kenya and such things. However, when we look at the equity space, that has not performed that well during the 5-year period. We've had very many things affect the equities. We've had the interest rate cap. However, after the repeal, we did see a bit of recovery, and even in the April quarter, we did see some of the large stocks start to recover. But when we look at the factors that have affected the equity markets in the last 5 years, they have performed quite dismally compared to offshore and fixed income. When we look at the overall performance for our schemes, we had a median performance of negative 4.2% over the quarter. This is largely attributed to COVID-19 effects, but over the period going to 5 years, we still have a performance of 8.5%. But what is important to note is the difference between the conservative schemes and the aggressive schemes. As I said before, aggressive schemes have a higher allocation towards quoted equities. So when you look at the quarter ending 31st March 2020, conservative schemes had a performance of negative 2.8%. They had a higher allocation to fixed income, and this helped salvage their performance. When you look at the aggressive schemes, however, they had a performance of negative 7.7%. We can see that through all the periods, actually on the longer term periods, the conservative schemes have come up stronger with a median performance of 9.1%. compared to aggressive schemes that had a performance of 6.9%. And this, just to end my presentation, we can also see where pension schemes have invested over the last decade. We can see that it has been almost the same trend all through from 2011 to 2020. We've had most of our investments in government bonds, and the other asset class is equities at 19% this quarter. However, we do note that there are other asset classes that we have not considered during our survey, such as private equity and other alternatives that some pension schemes have invested in, although a small amount. We are looking into ways of incorporating this into our survey going forward, but the main asset classes remain to be fixed income, quoted equities, property, and offshore. With that, I end my presentation. Thank you very much, and I look forward to hearing from you.
Thank you very much, Beryl, for that succinct summary and setting the scene for us. Beryl, I think you can turn off your video and audio now. I'd like to introduce our second speaker for today, David Owino, a partner at Ascent Capital, a private equity fund manager. David Owino is very well known in the industry. During this time of COVID, David is developing new IT skills as his kids are on e-learning platforms and regularly call on him for help desking. David, I learned, also learns the Latin language, although I believe this is during pre-COVID times. David, I recently learned that bonus is a Latin word that means good. That comment has no relation to my upcoming appraisals. On that note, I will just make a quick mention to Adil Suleiman, who's the head of the actuarial team, who's also supporting this webinar by responding to queries. Thank you, Adil. Please let's welcome David Owino to talk about an outlook for private equity. David, please switch on your video and audio and join us.
Thank you very much, Neha. I hope you can see me and you can hear me.
Yes.
I look like a dark man in the dark Africa, but thank you for that introduction. All I can say is omnia in bonum. All for the good. Exactly, yeah. So bonus or bonus is derived from the Latin word. Thank you for giving me this opportunity. I don't have a presentation to make. I thought I would just perhaps discuss with the attendants exactly what's happening in the private equity industry. What is the outlook given what has happened over the last 1 year? This is in 2019, coming into 2020. And then the expectations are mainly focusing on East Africa. I might just show you a page of one of AFCA's outlook for East Africa. When you talk about East Africa, in PE, we cover quite a number of countries. We include Somalia, we include Djibouti, we include Ethiopia, Sudan and South Sudan, and then all the way to Burundi, Rwanda, and Tanzania. So the scope is more Eastern Africa, rather than just the traditional 3 or 5 countries we know as East Africa. Again, in PE, it's very difficult to start analyzing issues. Of course, we analyze, but to sort of say what is the outlook for private equity given COVID over the next 3 months, because our outlook is always between 5 to 10 years. When we're looking at things, we expect things to change. But having said that, COVID has affected 2 environments which we might want to look at basically, which is basically the fundraising environment, where we are sort of going out there to raise funds to invest in investable opportunities. And then there is the investment environment itself. Do these opportunities exist? Or has that environment completely changed to the extent that the outlook might be very different from what it was maybe 3 months ago or maybe 1 year ago? Good news is that on the fundraising side, that the key pot of money that mainly African private equity funds look to raise money from has remained stable and faithful, and this is the development finance institutions. So we've seen increased, or not necessarily increased, but sustained allocation of capital to invest in Africa. I think most of these CFIs are backed by their governments, especially from Europe, and they've been backed to do certain things to achieve certain goals in Africa. And those goals are not going to be affected by the short-term effects of, or even the medium-term effects of this corona virus. So we've seen in sort of sustained review. The only effect we are seeing now is the inability to travel is creating a bit of what do you call it, breaks in everything that's happening, in the sense that for them to invest, and even for us as private equity investors to invest in anything, a lot of due diligence must be done. And these diligences take months and not necessarily just weeks. In fact, I stopped referring to them as weeks, because when you count weeks, you're counting 16 weeks, 20 weeks, so better say 5 months to do this. And now without travel, it's becoming increasingly difficult to sort of get allocation being given to private equity funds. But having said that, what I know is that we know at least there have been two announcements by the African Development Bank and Propaco in committing to funds in Africa. Propaco committing to $20 million to a North African fund, and AFDB backing a climate-based fund, a climate change investment focus fund with about $10 million. So that has not ended. At Ascent, we are doing our fundraising. We are hopeful to get to a close before end of August. Again, heavily backed by DFIs from Europe. So that is positive in the sense that, look, the outlook for those people who are experienced in private equity sector, they are thinking many years ahead of this of the current crisis. Yes, the current crisis is like the last 2 years, but our outlook is normally larger than 2 years. I saw Barry's presentation I had from Mao when he started comparing Q1 performance. In PE, you don't do that. In fact, you don't even do 1 year performance once we close the fund, because the J curve, the effects of the J curve, as we call it, because we're just investing now and we expect to harvest the investment in year 6, year 7 to year 10. So that's generally the outlook. Now, specifically coming to East Africa, we saw quite a number of activities happening in 2019. And the hope was that 2020 will be the year that we see it building up on the 2019 gains. And most of us will recall that after the election in 2017, 2018 was a bit of a frustrating year, and 2019 started picking up. And a lot of activities happened then. But what COVID has basically done is to reduce the deal activity. So you will hear certain deals being closed, but these deals being closed are deals that were already in process in the latter part of 2019. So it's a question of now negotiating valuations. If there's a feeling that there's a complete change in the structure of valuations in the market itself, given the crisis you're going through now, or people pulling sort of the trump card in all transactions that you do in private equity. There's always a force majeure trump card that you can pull and say, okay, fine, I need to negotiate this thing, otherwise I can't close this deal as it looks like. But if fundraising side things are looking good, most private equity fund managers now are focused on portfolio management. So basically, all the deals that you've done so far, all the companies you're holding your investments so far, how are you going to make them come out looking stronger in this particular environment? Good news for some of the private equity funds is that if you've got sort of leg room in terms of commitments, in other words, if you're a $100 million fund and you've invested, I don't know, 70 million, 70% of that, and you've got portfolio companies that are in your portfolio, will you be looking for new opportunities, or will you be looking for a defensive strategy where basically you look back and say, okay, fine, the companies that have invested are the companies I need to support so that they can go through this crisis and come out stronger. Our belief is that the economic effects of this crisis are going to be worse than perhaps the health effects of it in Africa specifically. And the economic effects are likely to last longer than the health effects of it. I'm sure all of us have some level of experience about the issue of employment now going on. Demand generally has gone down effectively across the globe, including Africa. But at the same time, it's good to think about the whole thing about, okay, so does this create opportunity also? There's been overly reliance on globalization. You can buy your goods from all over the place. You can buy your inputs or finished goods from China, bring them to Kenya or from Dubai. The question is that really, given the crisis we've gone through, is that really the way to go? Or should we then start thinking about creating our own unique industry so that we can become self-reliant? And to that extent, if that line of thought is pursued, of course, taking into account that we must be globally competitive, if that line of thought is pursued, we expect policy makers to start thinking about what can we do to enhance manufacturing, for example, to enhance industrials, at least in this part of the world, so that we can be somehow self-reliant and we don't have to really import our masks or anything like that. Certain basic things can be done locally. And if that's going to be the case, then again, opportunity arises there in terms of mobilizing capital to back these particular opportunities. And of course, the overall ripple effect would be positive to the economy, to the society in general. So focus on PE now, I think, has been largely on working on the portfolio companies that have already been invested in and backing them up to ensure they can survive this cycle. So a lot of our investors are asking us, so do you have enough runway in terms of capital that you can call to back a company that might be feeling a lot of heat because of this lack of demand coming through, so that it can come out stronger? Companies that are backed by PE funds are most likely to survive this because then they have got this pot of money that can help them survive through this. ensure that they have enough working capital to come out of this thing, eventually, more so than companies that don't have any backing of PE, especially in the SME sector. So SME sector, we think the companies that are backed by PE funds will come out stronger. They might come out more consolidating themselves. In other words, we're even looking at opportunities of consolidating and saying, if I have bought one company, which is Metro Plastics, is there an opportunity to then consolidate ourselves and make ourselves more dominant in the industry we play in? So that's the case. Secondly, someone might ask, what about valuations? Are valuations necessarily coming down? The truth of the fact is, yes, you can see the stock market has been hit, negative returns for quoted equity. But in PE, when you're doing deals, and even in listed entities, I have a bit of experience there. I worked there many years ago. If you want to buy sizable chunks, if you want to buy 20% of a bank that's listed, first of all, chances are high that it will be very difficult to get that chunk and to get that size. And even if you go that size, to expect that you'll get that size at the valuations being traded, at the volumes being traded now at those low prices, I don't think you're going to get that opportunity, because for us, we look at acquiring significant stakes in businesses. And in that sense, then we must then negotiate something that makes sense to the counterparty. Yes, valuations have come down, but have they come down necessarily by 50, 60%? I don't think so, because the outlook we are coming up with is longer term, and you have to be fair to the entrepreneurs all the same. And so it's more about structuring the deals more than just necessarily bidding down the prices so that you can buy cheap, as many people might say. Is how do we come up with a clever structure to ensure that the entrepreneur feels it's a fair game for them? So ratchets, for example, will be the earnouts, the things we will be coming up with. So, okay, fine. If you really think it's just a COVID thing and you'll come out stronger in 3 years' time, let's agree on an option or a ratchet or an earnout. I'll take 70% of your business now, but if you do well in a 3-year fund, it's sustainable, you can claw back 20% or 30% of the shares and you end up being a majority. So that then it's a win-win situation. You must be very clever on how you structure your deals now as compared to where we were before, pre-COVID. The sectors that are looking interesting now, of course, consumer staples is still interesting. It has been interesting even previously. Financial services, fintech, and infrastructure. So the things that are lacking in Africa. Education has also been very interesting. As you can expect, it has been hit by this COVID because of not going to school. I think Neha suggested that I've become an IT help desk person, which is true. I can't wait for schools to open. So I don't think classrooms will go away anyway. I'll be one who vote for classrooms to go back so that my kids can go back to a class setup. There are so many things that need to work for e-platform to work. Things will never be the same, we agree, but certain things will not necessarily change dramatically as we expect. And so, do we expect the fundraising environment? Last year, PE in Africa raised about $4 billion in total. Do we expect to achieve the same rate this year in terms of fundraising side? I think that might necessarily go down, but if you ask me, down maybe 20-25%. Using a certain example, if we do achieve our targeted first close of $80 to $100 million in first close for Fund 2, which we are raising now, our target is 120, it will mean that, look, it seems to make sense. But how is it working? It's simply because the sophisticated investors, especially from Europe, are relying on each other. So, an example is I said there are 2 or 3 DFIs that have already come down pre-COVID, done their own due diligence on us, spoken to us, and visited our potential investment opportunities, and they have gone through their processes and then passed a positive decision. Now, the ones who don't have a chance to come down to do the DD are relying on the diligences of these other credible investors who have already done diligence, and that's why the whole thing is still able to roll, and we are still able to then get commitments coming through for investment in Africa. The expectations from those investors is not that we will just take the commitment and sit on it and a management fee. They expect us to show them pipeline. They expect us to show them opportunities that are coming through. Where they expect us to put our skills in is how do we negotiate and structure these particular opportunities. Maybe I'll stop there and be happy to get questions that the panelists might have or the attendance might have for me in PE world. Thank you.
Thank you very much, David. That was great. I think a lot of interesting comments that you've made. I'm sure there'll be a lot of questions. I can see the numbers of questions are growing already. I think for me, a couple of things to note is that I think it's quite interesting, your comment on how private equity helps to support SMEs in our economy. It would be great to learn more about just how widespread that is and how active a role PE is playing in our SME market. We can address that later on. And also your comment on long-term focus. I think pension schemes are also in a similar position to DFIs in that sense, that this is a short-term blip, hopefully, and we do have a much longer perspective to consider. Thank you. Now, we'll move on to our next speaker, who is David Luigi from Gen Africa. He's the property investment manager. David is really enjoying cycling during this time of COVID on the roads, particularly with far less cars and much cleaner air. So that's great. David, keep that going. David will talk to us on his outlook for property in Kenya. David, please come onto the screen and share your presentation. I'll hand over to you.
Thank you, Niha, for the introduction and for the opportunity to interact with all of us insofar as analyzing real estate in the current environment that we are living in. Quite interesting times. So since this is, in my view, a real estate investment cannot be discussed outside the context of an economic structure, I've tried to split my conversation with you in a manner that just outlines the main economic considerations that any prudent investor should take, and it should be, I think, comprehensive enough to enable us to have a comment on all of the sectors, even if it's one or two comments, but at least we could just have a basis for discussion. So the first side will be the supply side. I'll be looking at what are the economic linkages that the impact coming from COVID might use as channels to infect real estate investments. We'd also look at the supply side in terms of direct supply, looking at the construction sector per se. And finally, we'll just look at the capital markets and any decision making and how it is being impacted insofar as new investment or existing investments in real estate is concerned. We'll then go to demand analysis, where we look at the four main drivers of real estate demand from an economic perspective, which is the sheer size or magnitude of the demographics, followed by the effectiveness of that demand by way of impact of COVID to incomes and wealth by extension. Thirdly, we'll look at whether, according to economic principles, real estate has a substitute, and what is COVID doing in that space insofar as making people look for alternatives for shelter if that possibility exists. And finally, we look at the outlook both from a perspective of the macroeconomics and the property market cycle, which we know pre-COVID was in Kenya already going through quite a tough time. Then based on that, we can have just some basis for discussion on what should we do as pension schemes, what should we do as existing or potential investors in real estate in Kenya. So to kick us off, the supply side, looking at what the coronavirus epidemic has done to supply side. One, in terms of essentials, the main infrastructure, which of all the various bulk infrastructure, so bulk infrastructure would refer to your water, your electricity, your sewage system, the road networks, any transportation facilities, JKA has been shut down. So we all know about the mantra, real estate is all about location, location, location. The whole point of that is real estate only derives its value from its ability to link to economic activity. And it can only link to economic activity using bulk infrastructure, transportation networks, building facilities and services, which is your water, power, data, and all that. So from my perspective, three have come to the fore, which are bare minimum essentials: water, electricity, to the point where the government actually decreed that there is nobody to be disconnected from either of the services. And then by the nature of the fact that we have to be physically distant from each other, data infrastructure has become an essentials infrastructure, more than sewage. Because sewage, you can deal with it locally, whether by septic tank or whatnot. But sewage could also be, foul drainage could also be one of the essential infrastructure items. So what this is doing is, on the supply side, for developers and for operators of existing real estate properties, those in terms of servicing, operations, and maintenance become an essential. And if perchance an existing development or a designed development under construction has not created redundancies for this, then from a supply side, it would be a challenge for such a project or a building to shield itself from the adverse effects of an economic or a public health crisis such as this. So based on that, we've seen some fiscal shifts where the government is now, and not only ours, but the whole world, stopping or reducing prioritization to new infrastructure projects, which is sounding counterintuitive to what I've just talked about up there. But this is because most of the revenues that are, or even the savings or incomes that are currently being received by governments and even by households is now being prioritized to survival, because either incomes have been cut off, or because now you're not used to your entire family staying in the house 24/7 for 3 to 6 months, then your home utility bills and even consumption like food and other recurrent expenditure have taken precedence, and therefore hard investments into hard assets, long-term purchases, or even what we'd call capital projects, takes low priority. And that will shift attention even from the existing contracts, where we will see that there might be a slow or a stall of bulk infrastructure projects, and therefore the economy will be left to, especially if we are talking of the private sector, will be left to fend for itself and especially dig into the pocket if redundancies don't exist and the public sector, the government, is not prioritizing bulk infrastructure because it's redirecting funds to survival mode right now. When it comes to operations, for buildings which are already existing and operating, operations and maintenance, simply because of the new health and safety guidelines, social distancing, fumigation frequencies, all these are new considerations which will result in more costly, the cost of occupancy being far much greater than has previously been. And therefore, when we look at service charges or service charge accounts for existing buildings, I opine that we will most probably have recalibrations of this, where you will find that service charge audits will show that they're running into deficits for the service charge accounts, and therefore operating to reflect the operations because of the low productivity and the new costs which are being introduced. And this is the same for any active construction sites. Some of our clients are actively on construction sites. Listening to the consultants, listening to the contractors, we can attest to the fact that, especially if you're doing offshore supply chains, those have been disrupted severely. notwithstanding cargo is still flowing generally, but port delays simply because of the higher costs of operations, social distancing and all that, testing of truck drivers. Cargo movement is much more slower, and therefore contractors are saying if they're not going to seek force majeure and stop the contract, maybe then we need to vary price and extend project timelines, because it was factors outside their control which they could not project. And at the same time, even for their existing machinery and labor force on site, because of those operating guidelines that I've just mentioned, they're also not able to be as productive as they would have wanted to be. When it comes to new investments, we see that each sector has shown us quite a different view. We used to say that lower income housing was going to give you pretty decent yields, but we've seen that in the face of economic shocks, now those higher yields actually reflect the higher risks, because the sensitivity to economic shocks in the lower or the bottom of the pyramid is actually that much greater. And therefore you will find that new investments that were directed towards the lower middle and lower end of the housing spectrum, or even the commercial sectors, might need to be reconsidered by investors, because they're looking at once you've pulled the trigger in real estate, your property market cycles are quite lengthy, the magnitude of your investments is quite huge, and the liquidity means that, or rather the lack of liquidity means that once you've made a move, you're more or less stuck, and therefore you need to be making sure you're making the right move before you pull the trigger. So when it comes to the demand sides, we're just going to look at two aspects. From demand, we look at what do we expect to see by way of the market size. I think it's very obvious. We've seen a slowdown in credit. We are hearing that especially in some tier 2 and tier 3 banks, maybe 15% or 25% of the loan book is being restructured. And even if NPLs were not shooting up, nobody is dispersing any loans. So any sellers of real estate that might have been looking for the credit market, be it through mortgages or developer finance, that might slow down. And when it comes to those who might have been dependent on business incomes or salary incomes and just savings, the reprioritization of your savings or cash flows is towards recurrent expenditure, not long-term assets, as we all hunker down into survival mode. For the rental markets, we've seen waivers and deferrals of rent. Either you're just exempted for a period, or the landlord restructures your rent obligations. And therefore you find that this has taken a hit because income levels have become either unstable or have been wiped out. And therefore asking, do people have a substitute? And because there isn't any substitute outside of you as a tenant actually raiding the lower segment, that is, if you're a middle income person paying 30,000 per month, you now have to go and look for a house that is 10,000 per month, therefore squeezing out that person who was paying 10,000 per month to another lower income segment. So you see that what we call lower income segment raiding, the entire population shifting towards the bottom of and bulking up towards the bottom of the pyramid in a bid to try and come up with a substitute for their shelter needs, which might lead to, post the COVID-19 crisis, a discussion around the sentiments onto whether do we buy, whether it's a business decision or a household decision, do we buy or do we continue renting based on the distress that these rental models have brought about. So in closing, if we were to look at real estate per sector, what does that supply and demand analysis mean to us in the next 1 minute? From a commercial sector discussion, when we look at the supply and demand analysis I've just highlighted it as best as I could in the little time that I have, we can see that now there has to be a focus on the more resilient sectors insofar as income and sustainability of rental income is concerned. whatever is classified or has been seen to be classified as essential will now become of interest to office landlords in the office and retail commercial real estate, and at the same time also in the industrial assets and specialized assets. Specialized assets are those which are operator-led. When I say operator-led, the business does not depend on the brick and mortar, rather it depends on the aptitude of the operator in managing the going concern. So you look at a hotel, so the building that houses Hilton doesn't really matter. It depends on whether it is Hilton or Radisson Blu or the operator. The building that houses a class is just a class, 10 by 10 room. Depends on whether it's a Nova, whether it's a Strathmore. So operator-led assets, we've seen hospitals have taken the fall. Schools, we think in the short term, like my colleague David Owino has just said, in the short term, they might suffer, but in the long term, they will bounce back because they are resilient in the sense that that is a demand that will continue, notwithstanding whatever new normal will be. Some sectors will not be affected in the long term. When it comes to the residential side, I think we need to recalibrate what effective demand has been, especially in the context of the affordable housing and Big Four agenda that we've been having. We've seen that, like I talked about, bulking up of the population towards the bottom of the pyramid simply because of the demand side effects on income, stability and sustainability. And therefore we find that the rental versus purchase models, developers or investors need to think really hard around effectiveness of demand, both in the rental side and in the sale markets. And in my view, the best way to do this is, because real estate has no substitute, then investors should actually not shy away from real estate. This is the time to come in when everything has gone cheap, but the way forward is to diversify from a sectoral perspective and also from a perspective, but also when we look at I call it capital, and you also don't go all purchase, you balance out your risks. I think I'll want to stop there. I've already done my 15 minutes, and I'll invite any questions, whatever I might not have touched on and glossed over. I'm open to the question and answer tab, and I will be able to respond to you there. Thank you.
Thank you, David. I can see a number of questions already coming through for you. So you can have a look at the Q&A section and start responding to them. And we'll come back with some more questions for you in the Q&A session as well later on. You'll see a poll appear, so please do respond to the poll. It'll be very interesting to get your thoughts and comments, especially after what you've heard. It's also nice to see some optimism in terms of opportunities and future growth from what David has just said. Now we're ready to move on to our next speaker, that is Dan Gathogo of Sanlam. Now we've given him a little bit of additional work. You may have heard recently one of the ratings agencies, Moody's, have recently downgraded Kenya's rating from stable to negative. Dan will tell us what this means, what impact this has on pension schemes, if any, should we be worrying about this. Thereafter, he will touch on his core topic, which is Eurobonds. Are these some of the things that we can consider as opportunities in this new normal time that we have been talking about? In terms of positive things for Dan during COVID, Dan is very happy that he's gained 2 hours of his life each day by giving up travel, which is great, I think, for many of us. But he's missing sports. Not playing sports, he clarifies, but watching live sport. Welcome, Dan. We look forward to your conversation with us. Please switch on your video, audio, and share your screen. Hi, Dan. Dan, I think your mic might be on mute. James, could you just confirm to me if we can hear Dan?
Hello?
There you are. Thank you.
Yes, just 1 minute. All right, thank you. Thank you, Neha, for that. So as Neha introduced, I'll talk about Kenya's Moody's downgrade that happened last week, and also talk about investing in Eurobonds as an option for pension schemes. This first slide basically is a slide that, and the main message that I wanted to pass is that we've generally seen downgrades across the globe, and it's not something that is just unique to Kenya. In the recent months, we've seen governments as well as rating agencies and multilateral institutions like the IMF progressively downgrade the economic focus of many countries. And as you can see from that chart, that's a recent chart from Fitch, and it really indicates the countries that they've really downgraded. So many emerging market countries, many frontier market countries have been downgraded to B status, just like Kenya, as I will share in a bit. Most of these decisions are based on expectations that economic growth will decline during this period as a result of COVID, and fiscal situations as well will deteriorate. And again, as David Owino had mentioned, health systems could be strained by this pandemic. If you look closer to home, 10 African countries have been downgraded so far since the COVID-19 pandemic, and these countries include Angola, Nigeria, and South Africa. So what governments and central banks across the globe have done is that they've really successfully supported financial markets through liquidity measures. As you probably have heard in the past, is that central banks across the world have really pumped in a lot of liquidity in economies, and that has really supported financial markets. However, the next phase, which is not very clear, is to assess the economic and fiscal damage. At this point, it's still unclear. It's still unclear on how the economies will be affected, given that it's not very clear on how economies will bounce back and when they will return to normal. Corporate earnings are expected generally to come really lower for this year, 2020, and that sort of brings us a cloud of uncertainty. And in our opinion, we think that the liquidity that has been pumped in by central banks across the globe might not be enough to make economies bounce back very soon. In our opinion, we think that rating agencies are just warming up, and we could see more downgrades coming in future. If you look at this next slide, we focus on Kenya, on the credit down rating. So we have had, as a country, Kenya, 2 recent downgrades by Moody's and the IMF. Moody's has changed their sovereign outlook for Kenya from stable to negative, while affirming the country's B2 rating. And I've shared a table there on your left, just for comparison and context purposes. And that shows the sort of ratings that other countries have as well. And the whole context about it is that we are more or less, we are not alone, given that sort of downgrades and where we are placed. The reason for Moody's change is primarily based on the assessment that Kenya's fiscal outlook will come under pressure, especially from a debt servicing point of view, as tight economic conditions prevail. IMF, also in their recent country report, which was published as of May 2020, also cite that Kenya's risk of debt distress has moved from moderate to high. They cite that Kenya's fiscal metrics are really exposed to exchange rate and interest rate shocks, given that 52% of Kenya's public debt is foreign debt. And with me mentioning that, I think it's quite clear that currency movement, that is the Kenya shilling versus US dollar movement, will be quite critical going forward, given that we've got, as a country, a high exposure towards external debt. The Moody's report, however, points out some challenges and some strengths within our credit profile. If we start with the challenges, is that our credit profile as a country is constrained by an elevated government debt burden and subdued revenue. And much of that subdued revenue is mostly because of the tax cuts that were announced by the government as a way of tackling the COVID-19. They also point out that our fiscal policy effectiveness and credibility are weak despite our fiscal transparency. And I think the background of that comes from the fact that as a country, we've always wanted, and we've always pointed out that we've always wanted to have lower budget deficits. And that has been coming down over the years, but has not come down sufficiently. However, they also point out strengths, and it's not all doom and gloom. Some of the strengths that Kenya has are a diversified economy, given that we are really not dependent on commodities, and also strong growth prospects post-COVID, and a mature financial sector as key mitigating factors. And that's a good thing about Kenya, probably compared to other frontier economies, in that we really have a diversified economy. That chart on the left, as I mentioned, really compares the credit ratings of other countries, which would consider as our peer countries. And as you can see that we are more or less, many frontier countries, many leading frontier countries, especially in Africa, have a rating of about B during this period. So generally, should we worry about our debt sustainability? The key facts, first of all, are that Kenya's overall public debt has increased in recent years. Public debt has increased from about 50% of GDP in 2015 to an estimated 62% of GDP as at the end of 2019. And this is mostly due to the large infrastructure projects that Kenya has done. Another key important fact is that about half of Kenya's public debt is owed to external creditors, as I mentioned. The good thing, however, is that most of this external debt remains on concessional terms. That is debt from multilateral lenders and bilateral lenders. That is your G20 countries and IMF and the World Banks of this country. A good thing to note is that concessional debt is actually much cheaper than domestic debt. Right now, on average, the average interest rate that Kenya pays for its domestic debt, which is half of all public debt, is about 12% thereabouts. If you look at concessional debt, much of that really comes in at lower single-digit numbers, numbers of about 4%, 5% thereabouts. And that's a good thing in that much of our external debt is actually concessional debt. However, what has been really increased over time is that the commercial component of external debt has really increased over time. Right now, within external debt, the split between concessional debt and commercial debt is about 70-30, with 30% of external debt being commercial creditors. And that is what is really within external debt expensive debt. That commercial credit debt comprises of bank debt and Eurobond debt. And that is what has really been increasing over time. What our government wants to do going forward is that they want to increase borrowing in external debt, but focus on concessional lending, which is much cheaper, as I mentioned. And I think that would be a good way of trying to manage debt. IMF have analyzed our debt sustainability in that recently republished report. And according to IMF, in their summary, that Kenya's debt remains sustainable, but they also point out that the risk of debt distress has moved from high, has moved to high to moderate due to the impact of the global COVID-19 crisis. What the COVID-19 crisis has done for our country is that it has really led to a decline of exports during this period, and that has really affected some of our debt indicators. If you look at the table on your, if you look at that table on your left, it shows some of those debt indicators that are used generally to more or less measure the debt sustainability of a country. From the tables in this slide, so all of these indicators, that is the present value of external debt to GDP, which is that first row in that first table, and the present value of total public debt to GDP, which is the first row in second table, are firmly below the indicative thresholds, and which is good. The thresholds are in the last column, and generally that is really good for our debt stories. However, there are some debt indicators that have actually, as IMF project, that will actually breach. And if you look at the present value of external debt to exports ratio, which I've highlighted in yellow in that first table, and the present value of external debt service to exports ratio, IMF expects that those two ratios could breach the thresholds that have been settled for countries like us, as per World Bank, or they classify as low income countries. So, however, in summary, what IMF expects is that they expect that our debt should generally be sustainable during this period on that. They also cite that Kenya's debt capacity is actually quite strong during this period. However, if you look again at those indicators that would probably breach the thresholds, those debt indicators are actually related to exports. And the reason that it's expected that they could actually breach the threshold is because we generally expect that exports during this time will actually suffer. But post-COVID-19, when exports revamp, it's generally expected that most likely these indicators will actually fall within thresholds. So overall, IMF, all factors considered, they generally think that Kenya's debt capacity is strong and that our debt is sustainable as a country. I'll focus on Eurobonds. And I think probably for context is that Eurobond, in our opinion, we think is an emerging US dollar investing opportunity that's coming up. And for context, a Eurobond is a bond that is issued in a foreign currency, mostly the US dollar. The sub-Saharan African Eurobonds that we're going to discuss in the next couple of slides are dollar-denominated bonds. And what we emphasize is that when you're looking at investing Eurobonds, it's important to review the debt sustainability of some of these countries before you decide to invest in a Eurobond. A key emerging issue that has come out during this period of the COVID-19 is on debt restructuring. And in this environment, many emerging market countries and sub-Saharan African countries have asked for foreign debt restructuring. IMF, the World Bank, and many G20 countries have committed to providing debt relief to countries that seek assistance. And this is positive for most of the sub-Saharan Africa countries in helping them meet their future debt obligations. This chart indicates the loans that IMF has disbursed so far since the outbreak of the pandemic started as a percentage of the GDP. Whilst the absolute numbers are sizable, for instance, Kenya has, we've seen a disbursement of about $750 billion. While those numbers are sizable, the percentage as a percentage of GDP is between 1.2%, as indicated by that chart. At this point, it's not clear whether China will offer debt relief for sub-Saharan African countries, but given the significant amount of debt that African countries owe to China, a debt relief from China would really go a long way in helping African countries meet their foreign debt obligations. In our opinion, when it comes to debt restructuring, we think that cash flow relief is clearly needed in this period and would be positive for countries in dire financial straits. What IMF and G20 have done is really quite commendable. However, the inclusion of private creditors like Eurobond holders and the banks for debt relief could be a double-edged sword, in our opinion. Whilst it will provide more relief to these countries, the possibility of rating downgrades and potentially messy discussions with the private creditors could inflict long-term damage on some of these countries' ability to raise external debt in future. And it's noteworthy to point that many countries have issued Eurobonds, and some of these Eurobonds, many of them are maturing in 2024. So if private creditors shun African countries in 2024, African countries could have a hard time in refinancing some of these Eurobonds. And what we've seen actually is that African countries that could be grappling with the debt crisis are really resisting calls to renegotiate with the private sector bondholders, given the outlook for fear that it might damage the access to financial markets in future. So far, within the African countries, we've only seen two countries, Kenya and Nigeria, coming out exclusively and mentioning that they'd actually not include Eurobonds as part of the debt restructuring plan, which again is positive for Kenya and Nigeria Eurobond holders. As a close-off, we show a slide on what sub-Saharan African bonds have done. And again, in anticipation of the decline in growth rates of the economies in sub-Saharan Africa and the lack of clarity on whether sub-Saharan countries will seek for debt relief on Eurobonds, many sub-Saharan African bonds have declined in price, as shown on that chart on the left. And as prices have declined, the yields have risen, again as shown on the chart on the right. Notably, the Eurobonds for the countries that are oil exporters, such as Nigeria and Angola, and those with high or what is perceived as unsustainable debt levels, like Gabon, have the highest yields. Oil importers like Kenya, Senegal, and Ivory Coast have generally proven more resilient during this period. And if you look at the price performance in the chart on the left, Kenya, Senegal, and Ivory Coast have not had significant price declines during this period. In our opinion, as an emerging investment opportunity, the high yields right now could probably provide a good investment opportunity for countries with a sustainable public debt, such as good debt service ratios post-COVID-19. And that's why I mentioned in the previous slide that it will be very important to analyze the debt sustainability of countries as you look at investing in Eurobonds. The support for many Eurobond issues from the IMF and G20 countries will really help and will really go a long way. But however, what we see as a distractor in the next coming months is that the debt restructuring noise may weigh on some of these Eurobonds. So yes, we are saying while most countries might benefit from a standstill from the debt service, and also if China especially comes through, countries that are supporting a commercial debt moratorium may see their Eurobonds underperform during these periods. On the other hand, as I've mentioned, the countries that have exclusively said that they will not seek for a debt moratorium on private sector credit, especially Eurobonds, might do very well during this period. And we've pointed out that Kenya and Nigeria so far have pointed out that they'll actually not pursue a private sector debt moratorium on Eurobonds. I think with that, Neha, that's the end of the presentation. We'll take questions during the Q&A session. Thank you.
Thank you very much, Dan. Again, some cautiously optimistic messages there. There are already questions coming up. I want to say thank you to our panelists and also Adil, who's helping out once again in really efficiently dealing with the messages. I think a lot of them have been responded to already. Dan, if I may request you to turn off your video, please, for now. Okay, our final speaker today is Peter Anderson, who's the MD of UAP All Mutual Asset Management. He will be talking to us about derivatives as an opportunity. Sorry, Dan, could you also stop sharing your screen? At the test run yesterday, we saw Pete, who looked nothing like the picture he sent us for the profile that we've used. You can see him appear on screen now. In terms of the positive news on COVID, Pete seems to really be enjoying online shopping, but is missing working out at the gym. But speaking of working out, just a quick announcement. Zamara has a special workout webinar this Saturday from 4 p.m. to 5 p.m. Pete, I'm sure you'll be there, and hopefully all the attendees of the webinar will join us as well. Pete, welcome. You can switch on your mic and share your screen.
Good morning, Neha. Is the screen showing?
Yes, it is.
It is. I just want to thank Zamara for the opportunity to present. Much appreciated. I will just dive into the presentation. The presentation covers derivatives. It's just a short intro really around derivatives, and I think following on from what Beryl's presentation at the start of this webinar, where obviously viewers have seen that equities have been significantly impacted, I think this is probably an apt time to talk about derivatives where they can provide some protection in portfolios where you may be looking to reduce risk exposure. Equities or shares being an exposure in the portfolio and a significant one that sometimes has outlying performance, just as we have seen in Q1 2020 due to COVID-19. I'll just start on the presentation. So just on the first slide, I just want to explain what we really mean by derivative. I mean, it is essentially really a contract or an arrangement, an agreement, a binding agreement between essentially two people, okay, where those parties are obviously trying to achieve a gain on taking this contract. And in this sort of situation, what you're really trying to do is, if we think of around shares, which is the underlying security, we are trying to hedge generally or gain against fluctuations in the security that you're holding. So for example, most investors and most fund managers will be holding Safaricom in their portfolio, and obviously be concerned if the share price was to fall. And a derivative, if you want to hedge out that, would be able to profit from it falling, so that the shares you're holding in your portfolio may lose, but your derivative may gain, and that is into hedge. And if you're an investor who's not even holding any Safaricom, but you want to try and profit from the fall, you can take some exposure to that derivative in Safaricom and profit from it actually falling, as well as profit from it actually rising. So you can actually put yourselves both directions of the security of the market, depending on your view. So derivatives have been done on a variety of financial securities: stocks, bonds, commodities, currencies, interest rates, and market indices. And as I've mentioned, they can be used to speculate, where you're just looking to profit from the gain or loss, and to hedge, where you may be a holder of the underlying investment and you want to hedge out any loss or gain that you have on the stock that you're holding in your portfolio by taking exposure to a derivative. So that first thing is probably what I'm going to touch on a little bit more. Risk management is fundamentally about hedging the risk that you have in your portfolio. So if you have in your portfolio, basket of stocks and shares, exposed to the vagaries of the market and how people view them, you can obviously hedge that out by using a derivative, as I said, giving that example of Safaricom that I've explained, and I'll also show some numbers later on. Yep. Also, if you're an individual who does not have any exposure, and what you're looking for is to get some exposure, instead of buying the shares directly, you could actually take derivative exposure in different types of shares or in the index, for example, and determine your view. If your view is that you believe index or share prices are going to rise, you can take derivative exposure and profit from that, what we refer to as taking a long position. So you buy at today's price and hope to sell at a higher price. I think this is pretty common to everybody and fairly easy to understand. And the contrasting position is that you can profit if the price is to fall. And that is you sell at today's price and later on come back and buy what you have sold at a lower price, and thereby profiting from the gain. You've sold, and then you later come back to buy what you've sold back, what you've sold to buy back, and to profit from that fall in the share price. And that is what we call taking a short position. And you often may hear, hedge fund managers talk about being long or short the market, and that's really what they're trying to say. Bring it closer to home. The Nairobi Securities Exchange has offered single stock futures now for over a year, having gone through significant amount of testing in the marketplace. So they offer a number of single stock futures in Safaricom, ABSA, KCB, Equity, EABL, BAT, as well as on the NSE 25 share index. So you can actually take positions based on your view of being long or short on those derivatives. Also important to note is contrast in terms of the fees to trade shares. The fees to trade a single stock future is around 0.17%, an index future around 0.14%. And I think this is probably on average around 1/10 of the cost to transact when you buy the normal shares that are listed at the NSE. All markets have a certain sort of structure, and of course the NSE is at the center of this. They are what we call the clearinghouse. And of course, when you take a position, and I have bought and contrast you have sold, because you're on the opposite side of the trade, we need to have somebody who is in the middle, who will ensure that no matter what happens, each individual party to that contract will settle. And that is what the NSE acts as, the clearinghouse, to ensure that the gains and losses go to the respective trading participants, who have them. Of course, involved in that, there needs to be some banking participants, which at the current time is a Co-op and a Stanbic, and they're involved in ensuring settlement is done in terms of the payment. Okay, there's a Pacific market exchange that is for derivatives, known as the Next, and this is actually standardized across the world. You'll see this in most markets. And also importantly is to understand about what we call the standardized contracts, because these contracts are not just agreed verbatim or between two individuals. They're standardized contracts. For example, if you wanted to take a position in Safaricom, there is a contract known as the June Safaricom 2020 or Safaricom June 2020 contract that allows you to take a position depending on what is going to happen to the price of Safaricom between now and then. And thereby you can take a relatively short position because that is only a few weeks away. There's also standardized contracts for September and also December. So it's always 3 months, 6 months, or 9 months, 3 contracts out, or 3 standardized specifications. This is pretty normal throughout the world. Trading members are the brokers, stock brokers, and investment banks that are licensed by the Capital Markets Authority. And those, of course, are who the clients, which could be individuals or fund managers, will use to facilitate, to execute the trades that they want. And those trading members will have signed you up to be able to do that, so they can execute them through the exchange, looking to buy or sell depending on your order. Visually, that is the structure on the next slide. The client is where individuals and fund managers would be. Trading members is where stockbrokers and investment bankers are, who will then execute the trades through the variety of the 2 clearing members. And the clearinghouse, the NSE, at the top to ensure the gains and losses are accordingly given to each person on the trade, and there is no breach of that contract. One of the key differences in terms of buying a derivative is that you must put up what we call an initial margin, and this initial margin will be calculated by the Nairobi Securities Exchange. So it may vary from 10 to 20% of the position. So if you want to take a position, say in Safaricom of 1 million shillings, they may say you will need to stump up or put up rather 15 to 20% of that as margin. Okay, this margin will be put up by the buyer and the seller because you're all taking exposure. I'm, say, looking to sell Safaricom because I believe the share price is going to fall in the coming months, and the buyer and the opposing party is looking to buy. We both put up that initial margin. It is held by NSE, but important to know it will be refunded in its entirety at the close of the contract or the close of the position. There will be some additional margin. These are two additional margins, which is one is called additional margin, one is called house margin. And these are, I won't go into the detail, but just additional margin that may be required depending on the risk of the client. So if the client has a little bit of a higher risk, they may be required to put up a little bit more margin. The key thing that changes from day to day is the variation margin. Today, I've taken a position to sell in Safaricom, say at 30 shillings. And tomorrow, the price has fallen. It closes at 29 shillings today. I am in gains at that current point. Okay, and opposingly, the other person who bought has a 1 shilling loss on each share that they took exposure to. That gain is actually distributed on a daily basis, the gain and loss. So what will transfer to me is some of that margin would come back to my account, whereas the opposing party who's in the loss would have to give more margin because they're in the loss. So the gains and losses are distributed on a daily basis because the derivative is priced daily, what we call mark to market, just like regular shares. But in every day, the variation margin will change. If I'm losing, I give some more to the Nairobi Securities Exchange, and conversely, the opposing party does the same. This is to ensure that when the position is closed, it is very clear what your position is, and you actually can determine what your gains and losses are. I've already talked about hedging, and I think people have understood. I'm holding a portfolio of shares or one share, and I'm trying to hedge because I'm concerned maybe the market is going to fall, for example, and therefore I can profit from the derivatives trade, but lose on the physical shares that I may hold or the electronic shares I may hold. If you don't have a position at all in shares and you just want to take exposure to the derivative market, you'll notice I've mentioned you can just do initial margin, say in Safaricom of 200,000, and profit from taking exposure in 1 million shares. So there's sort of a higher return you can get because the gains are leveraged. I've only put up 200,000, but I've got exposure, say, to 1 million. And that obviously leverages up the returns. That is, of course, more risky because you can lose as well as gain. And that is something that should be very well appreciated. I've discussed the lower transaction costs. One of the key risks, of course, which is why the NSE sits at the middle of this, is the counterparty risk, because you're trading with somebody on the other side. And generally you may be trading with another institution, and they've provided initial margin. They've been vetted. If it's an individual, they've been vetted to ensure that they can stand the agreement if should they lose on this trade as a counterparty. And that by having NSE at the middle, they ensure that this counterparty credit risk is lowered significantly. Your risks, obviously, which I've mentioned, one of them is that default risk, which I think is relatively low. It's very rare for an institution to be able to default on a derivative trade. Their positions are monitored daily, so it's understood what their exposures are. And then the market risk, as I've already mentioned, is obviously you can gain or lose depending on what happens on the position that you have taken. A little bit about what I referred to as the standard specified contracts. Just touching on single stock futures, which covers around, I think, six shares right now. Obviously, there's contract sizes, which just lets you know that when you buy one contract, what sort of exposure do you have? How many shares have you actually taken exposure to? And if you're in the case of a share that trades under 100 shillings, as do many of them, each contract is equivalent of having 100 shares. The contract months, which I've mentioned, March, June, September, and December, and you can decide depending on your view. If you're wanting to take a view this year that the market is going to rebound strongly, you might want to take a position, in the December contract, looking to exploit the opportunity that maybe share price will be significantly higher. How are these contracts settled? Well, they'll be settled, based on a theoretical price or a traded price, basically on the third Thursday of every expiry of the month. What's important to realize is you don't need to hold the position to the expiry date, okay? So if you've taken the next contract, which will be June, the third Thursday in June, you do not need to hold to that date. If you're in the gains, or in the profit rather, you can sell to get out of the position. So you can actually exit the position after the same day, because you can buy and sell in the same trading day and be out of your position having taken gains. Or you can just hold it to the expiry, and then those gains and losses are offset through NSE, get the return of your initial margin as well as your gains or losses. This is my last slide, which has a little bit of numbers, which I hope will illuminate it a little bit more for you. On the left-hand box, we're just talking about taking exposure to Safaricom. And the exposure you can see there, if you run through the table, is essentially 250,000 shillings of exposure to Safaricom, which is the equivalent of around 1,000 shares, at a trade price, let's say, of 25 shillings. Now, if the exchange has requested initial margin of 10% on your 250,000 shilling exposure, you're going to need to put up a little exposure of 25,000 shillings. There may be some additional margin, which is usually calculated at 10% of the initial, and total margin would then be 27,500 that is required to give you exposure to 250,000 shillings worth. This client, or the fund manager, for example, actually already holds 10,000 Safaricom shares in the portfolio and is purely looking to do a trade that is going to hedge. The client believes the price will weaken in the immediate future and therefore is looking to hedge against those losses. Or if those 10,000 Safaricom shares, if the share price was to fall by 5 shillings, you'd lose 50,000, or 3 shillings, you'd lose 30,000. So the hedge is essentially taking a short position. We've sold 10 contracts of Safaricom worth 250,000 shillings at trade price of 25 shillings. And by selling those futures, you are looking to profit or gain from the downward price movement. You are the seller, that is your profit, and the buyer, who's somebody on the other side who believes the price is going to go up, they will naturally lose if you are correct. So if you enter this position at 25 shillings and later on close the position out, and in this example, we're actually saying it happened very quickly. You may be transacted on the 4th, executed a short position at 25 shillings. On the 4th of May, it closed at 24 shillings. And what you can see in your P&L, as we would say, you gave some initial margin. Initial margin was given of 25,000 shillings. Variation margin is showing the profit that you've made, okay? And essentially what it's showing you is that based on what you've given forward for the initial margin, you are in a gain on the first day of roughly, on a cash flow basis, of 17,925. You'll notice the trading fees are just 425 shillings. The second day on the 5th, the share price drops further, 22 shillings. And you probably then decide, let me close this position right now because I've actually hedged and I don't think Safaricom is likely to fall any further. Looking at the complete table, what you will notice is the gain that you have made is easy to work out. It is 3 shillings, times the 10,000 shares exposure you have, which is 30,000 shillings profit, less your transaction costs, which was 850 shillings in total. The initial sell and then the buy to close the position with a net gain of 29,150. I think the key point to understand is really the closing box at the bottom. The derivative position allowed you to achieve a gain of 29,150. Where the Safaricom shares that you're holding in the portfolio, you would have had an unrealized loss because you were holding them of 30,000 shillings, 3 shillings loss on the 10,000 shillings held. With this, you have managed to nearly offset the entire loss to the derivative exposure. Your only cost is the very modest trading costs. For a round trip, was probably around 0.34% of your value, which was 850 shillings. You've essentially managed to complete almost a 100% hedge in your Safaricom exposure. And you could do this across other shares you hold in the portfolio that the NSE has, those single stock futures, as well as just doing it on the index where you want to just protect yourself against a broad fall in the market or a broad gain in the market. With that, I think that's my last slide. I will stop and be taking questions in the question and answer. So I'm back to you, Neha. Thank you very much.
Thank you, Pete. If I could just keep you there, actually. We've had a couple of questions come through. I think our Q&A session will be around 10 minutes. So if I could request the questions that I'm asking, if you could just respond within 2 minutes or so. Pete, one of the questions that has come through is derivatives sounds risky. It sounds like gambling. Could you just make a comment on how you think it's different from gambling? And also in terms of the current liquidity in the market.
Thanks, Neha. Obviously, that's a great question and often asked about derivatives. Are they risky? Is it gambling? But remember, every time an investor holds shares in their portfolio, they're taking a view. When I buy shares, I'm taking a view that the market may rise. If I'm looking to take a derivative short position, I'm taking a view that it may fall. And remember, the contract allows you to take positions over 3 months, 6 months, or 9 months. So while it may be looked at someone who might think that's gambling, you're actually taking an opinionated view about what could actually essentially happen. It's important to probably say that the example that I've given here is primarily focused on hedging. So you are trying to hedge out the risk you have in your portfolio. You're eliminating. The example that we showed at the end there is eliminating all your risk. So it's actually eliminating the risk you currently have in your portfolio, because your portfolio might have significant exposure to Safaricom. By taking that derivative exposure, you've absolutely eliminated all your entire exposure to Safaricom through the hedging. However, if you're taking what I might call a naked exposure, you don't have any exposure to Safaricom. You thereby decide to take a derivative. You are sure you've increased your risk, but it is an informed risk. I would hope so, and therefore you'll profit or gain. And I think it will still look at fundamentals, technicals, and the likes. And hopefully, if you're on the right side and got that correct, you will profit over the time period that you're holding the contract. Now, in terms of liquidity, that's an important aspect. And I think, there's a well-known saying that says liquidity begets liquidity. And the actual fact is liquidity is fairly light, but it has been growing since inception. And as more participants decide to enter the market, the actual volume of trades and the ability to execute will improve. I would not say it's the ability to go out there today and say you can hedge 1 billion shillings. That's probably unlikely, but it's something quite practical, because if you think about it, say you knew that Safaricom was going to fall in share price this quarter, or KCB for that matter, you could have gone and sold the shares, and then maybe later in the year when you think things have calmed down and bought the shares. That would have cost you around 2% for a round trip in your portfolio. Okay. Instead, you could have reduced some of that exposure through the derivatives for a very low fee. You might not have been able to do the entire position, but some of the position could have been hedged down through the derivative, and that's cost effective. And in the end, by trying to keep those fees lower, the client will ultimately get greater returns in the future by not having that transaction fee drag. Back to you, Neha.
Thank you so much, Pete. Appreciate that. I think there may be 1 or 2 questions. If you could just have a look at the Q&A tab. I'd like to move on now to David Luigi. A question for you. If you could please come on the screen. You've talked about diversification in your presentation, that in the ideal scenario, you would have a pension scheme diversified between commercial and residential and various other types of diversification. According to ZCAS, 20% of the pension schemes that we cover are actually exposed to property. Many schemes have not yet invested in property and certainly may not feel they have the ability to diversify between different types of property because of the limitations they have for liquidity or asset size. So what advice would you have for such schemes? Is property still available to them?
Thank you, Nia, for that question. I believe that is a very relevant question, because I'm talking of diversification, and yet most investors are barely able to afford even a single asset. So much for diversification. And that is where pooled mechanisms or indirect investments comes in terms of relevance. So when you look at equity exposure, you have your public equities and you have your private equities. So Nairobi Securities Exchange does the public listings of your Safaricoms, banks, and other counters. And I think David Owino has done a good job as to explain what the private side of equities is concerned. There's also a similar dichotomy in real estate. We have the public pooled real estate, otherwise known as REITs, Real Estate Investment Trusts, and we have the private equity equivalent of private real estate that is still pooled. So my advice to schemes would be look at the private real estate, private equity real estate, otherwise known as property funds, as one of the potential alternatives to the public real estate that is pooled, such as REITs, the real estate investment trusts, for you to be able to achieve a diversification objective. By its very nature, diversification means having a composition of several assets exposed to several sectors, exposed to several strategies, rental versus purchase markets, which is income versus capital growth objectives, exposed to several risk profiles, low risk, medium risk, high risk, like the low end of the market. We've just seen people are now unable to pay rent. So the indirect investing would be the way to go. But we've seen also a challenge with respect to indirect investment, especially with the REITs performance in Kenya. The regulations are currently under review because most of the pundits in the industry have said that the problem as to why this is not performing well is because of the structure of the REITs. So I'll take this platform, probably unfairly to Zamara, but I'll take this platform to say that Gen Africa has actually thought about these pooled arrangements, and we are proud to say that we have recently launched the Batian Property Fund, that is private equity real estate, that should be able to provide an avenue for schemes to diversify, because we are structuring our investments insofar as exposing ourselves to social infrastructure, what I was calling the resilient or low risk side of things, because we've seen hospitals will continue operating, other social amenities such as schools. Once this COVID stops, they will continue operating. So social infrastructure investments, the real estate component, can be one way in which to diversify the commercial real estate exposures for schemes. And then by strategy, don't only pursue one strategy, either going into development or rental, have a mix there. By income segment, like I said, don't only focus on the high end, try and distribute yourself to the bottom of the pyramid, middle of the pyramid, high end of the pyramid, but all this is all through a pooled mechanism arrangement. And you can reach out to us at Gen Africa for more information about the Batian Property Fund, or you can survey the market for other pooled mechanisms for investment into REITs for you to be able to achieve the diversification objective. I think I'll stop at that.
Thank you, Luigi. Glad you got your opportunity to make a quick plug there. Thank you. We're running out of time, but I would like to just ask David Owino a question that has come through on the Q&A icon up there. So David, just a quick comment, if you may, on the regulation of private equity. We do know it is an unregulated asset class. Perhaps a quick comment there. And there was also a question on what PE do you have available? I believe at Ascent, do you have any opportunities available is what the question is. So if you could kindly respond to those.
Thank you, Neha. The second question was what if it's Ascent is available as an opportunity, or?
Indeed, that question did come through. I'm sure it was not planned.
Okay, the short answer to that is yes, but let me start with the regulation bit. I think people have seen the draft finance bill that has come through, and there's a bit of concern where the Capital Markets Authority has it's proposed that the Capital Markets Authority be allowed to regulate, license private equity funds that raise money from public funds. It's a very general statement that has been put in the finance bill. First of all, to meet the whole idea that private equity is not regulated. Private equity is actually regulated. The only thing that happens is that if the domicile of the private equity is in Mauritius, for example, then the regulation ambit is in Mauritius and not in Kenya. And so when people see private equity doing transactions in Kenya, they get the feeling that it is not regulated simply because there is no arm of government in Kenya that is actually looking after the activities. But they must obtain licenses where they operate. So, for instance, you must get a license from the Mauritius Financial Services Authority for you to be able to then set up a private equity fund and a manager to be able to operate. Remember, I said that we are backed by DFIs, Development Finance Institutions. These are government's investment arms. A similar one in Kenya would be ICBC. It's not active in the market. It was active in the 70s, doing a lot of good things in the 70s, actually industrialized this country to the extent you could say in the 70s. But given that they're backed by governments, they'll be very keen on ensuring that the pots of money they're giving to invest actually follow a particular pattern, and reportings are following a particular pattern, and as such. Why can't you set up a private equity fund in Kenya? Is simply because the operating environment, the legal environment, is not as respected internationally as perhaps Mauritius is. Okay, so many international investors will be comfortable investing in a vehicle that's regulated under the ambit of Mauritius as compared to Kenya. So Kenya has got the work to work, has got the hill to climb. Basically, prove that you can be a very good destination. How do you prove that? For instance, if you take something to court, one key question is that if you take something to court in Kenya, how long does it take before it's resolved? And the answer is not normally very nice. It can take years before an issue is resolved. That is not very attractive to international investors. Then they don't believe in the legal system. There are so many things that have to be worked out in Kenya before the environment then becomes that attractive in terms of a regulatory perspective or structure perspective for people to then start saying, look, we can set up a fund in Kenya and you invest. So we will see, and Mauritius is not sitting back and waiting for Kenya to catch up. They're also trying to do as much as they can to ensure that they are in a good place. I can tell you they are in a bad place now as Mauritius because the EU has almost blacklisted Mauritius now. So even setting up a fund in Mauritius in future is going to be a problem unless they resolve a certain requirements of OECD and European Union. So that's the dynamic that there is. So for CMA's attempt to do this, I think for me it's more dangerous in the sense that it might then necessarily mean that private equity fund managers avoid raising money from local investors, because if someone tries to claim that they're going to regulate, then they will avoid. You don't want a double whammy where you're regulated by CMA and then you're regulated by Mauritius Financial Services Commission. Yet 90% of your money or 95% of your money is actually international, and only 5% is coming from Kenya. So at Cent One, we are $80 million, and only $6 million is from Kenya. The remaining 74 million is international investors. So I cannot put to risk the 74 million. Well, at the same time, so does it mean that now I'll be bringing international money to invest in local entities, and if I make a good return, that money goes out? There must be a good balance, and I think the policymakers must think about this carefully. To the day we will expect to see commitments coming from local investors amounting to 50, 60%, or even maybe 40% of a private equity fund. So a $100 million fund, $50 million is from local money. Then you can push for that such as legislation. But a $100 million fund and only $5 million coming from local money, and then you want me to regulate me, it doesn't work. And so I think the attempts that are there are not well informed. I think we are engaging with the policymakers ourselves to ensure that they can see what this means in terms of giving access to these private entities to, for example, pension funds. Yeah, someone asked that. So what are these companies investing? So the Java deal that was done by ECP bought into Java, invested $30 million, and then sold to Abrash for $120 million. So they made 4 times money from whatever we have in the public space. Yeah, and Java has grown. It's we Kenyans who are drinking Java coffee. We like Java. We think it's our local brand, but the ownership of Java is not Kenyan. Yeah, so there must be a way to figure out how we do these things. Stock market is there, but you only have, to be honest, we only have less than 20 companies who can invest in the stock market, or maybe 25. In fact, I'm exaggerating. Safaricom takes more than 50%. Now, how do we get opportunities for our pension funds to invest in this vast universe of potential opportunities to go in? And the only avenue we have at the moment is private equity. So there must be a way that this is approached in a way that makes sense for all players. The caveat is, and this is across the world, private equity never takes 20% of asset allocation anywhere. Well, I think in the US it's where it's most advanced at maybe 22, 23%. In any given pot, you'll find that even a pension fund investing in PE, they'll only put in 2%, 3%, or 4% of the entire asset allocation. So it's not like you are risking so high by going into private equity, because from your asset allocation strategy or policy, it's just a portion of it for you to take advantage. But then, Neha, you asked this question, it does the catalytic effect, because we invest in Kisumu concrete, we invest in auto streams, we invest in metro plastic. These are Ascent investees. These are companies employing Kenyans and looking to go Kenyans. And if there's a return to be achieved, it will be best if that return is first enjoyed by the Kenyans. And unfortunately, I think the first Java deal that was done by ECP selling to Abrash, I don't think, if any at all, there was any Kenyan pension fund or investor who derive benefit from that. But we still need profit from that. Thank you.
Thank you. Thank you very much, David, for your insights. We really appreciate that. I think we do need to wind up. We are running out of time. And there are still some questions, and panelists will try and answer them. I think there are very few that have not been addressed so far. The poll results have also been shared now. You will have seen them on your screen. Very motivating to see that many of the attendees will be open to considering opportunities in Eurobonds and derivatives. We had 41% say that they would consider Eurobonds, and 80% say that they would be open to considering derivatives, which is very heartening. Thank you very much for that. I would just like to close off now. A big thank you to our speakers. We are very grateful for your time and your insights. And thank you all for joining us today. We will be sharing the presentations and also a video link if you would like to refer to anything once again. Please continue to join us for our webinars. We hope to see you on Saturday at 4 p.m. at our workout webinar. Please stay safe as we all evolve along with our new normals. Thank you very much. Have a good day.